Interest rates are finally coming down, and that's such great news for buyers and sellers. But as we've discussed, when rates fall, competition tends to increase as buyers come off the sidelines. So now more than ever, it's important to be a savvy and knowledgeable buyer or seller. So today I want to share some very common mistakes or misconceptions that both first-time home buyers and repeat buyers make. I also want to share how to set yourself up to get the best interest rate possible. Let's get started. Hey there, welcome back to my channel. I'm Erica Monroe. I'm a realtor in the Bay Area and I specialize in Solano County. We've now seen about a 0.5% reduction. With a little luck, we'll continue to see additional mortgage rate reductions throughout 2024 and into 2025. And that is real money, thousands of dollars in potential savings. Now the rate may still be a little volatile. We may see it tick up from time to time, but it looks like we're going to be heading in the right direction. Now, the best way to save money, of course, is getting the best possible interest rate. And when lenders look at offering you a rate, they want to see what quality of buyer you are. And they look at, of course, your credit score and your FICO score. And one component of that is your credit utilization. Basically, how much debt you have versus your credit line. Let's say you have $10,000 of accumulated credit card debt, but your credit line is $40,000. 10 divided by 40 would be 0.25. So you would have 25% credit utilization. That's right in line with what lenders are looking for. They're looking for anywhere from 30% and lower, ideally 10% or lower, but you very well may qualify. You just might not get the best possible rate. Here are a few quick tips on how to show lower credit utilization. Is going ahead and paying off your credit cards or making those payments prior to the due date. That'll show lower credit card utilization, lower debt versus your actual credit line. Requesting credit limit increases on already existing credit lines. Do not open new lines of credit. Absolutely speak to a lender before you make any adjustments to your credit line. Leave paid off cards open and avoid closing any credit lines. The more credit you can show, the lower your utilization rate will be. Now, if you are buying with a spouse or a partner, it's important to understand that both of your credit scores will be utilized. They'll pull from 3 different sources. Generally, they'll average the 2 middle scores from each of you. If one of you has stellar credit and the other has very poor credit, unfortunately, it's going to bring down your credit score and likely cause you to have an increased interest rate. So if one of you is struggling, I definitely encourage you, have a conversation with the lender to figure out whether it's worth waiting to work on that credit score so that when you are ready, you can command the best possible rate, saving you real money each month and possibly thousands of dollars over the course of the loan. Now, I often have buyers state that they're petrified to have their credit score run because they've heard it can ding their score and actually bring it down. Well, the reality is you're not actually taking that credit out, so you shouldn't receive any sort of penalty. And especially if you're having your credit report run 1, 2, or 3 times within a month period or so, the industry knows that you are simply trying to shop rates, you're trying to get the best deal, and they want to encourage that environment. So it typically only counts as 1 credit pull. And at the very most, maybe while you're in contract, you'd have to sign a letter saying, yes, I had my credit run 2 or 3 times because I was trying to get the best possible rate. That should be enough evidence for the lender or the underwriter who's requesting an explanation for those additional pulls. Let's move on to some misconceptions. The very first one I want to talk about, despite what you see all those $1 million listing agents talk about on TV, is trying to establish value of a house based on price per square foot of a recently sold home. It's so much more complicated than that. In a competitive market, it's really important that you understand how appraisers establish value for a property. Remember that if you get a loan, you're more than likely going to have an appraisal because the bank wants to make sure that you're not going to overpay for the home. For example, let's take 2 houses that are in the same neighborhood. Let's say one house is 1,000 square feet. The house a few doors down is 2,500 square feet, so a significant difference in size. When we're establishing value, value is the accumulation of all the components of the home. So you get credit for how many bedrooms and bathrooms there are. You get credit for the lot desirability, the location, whether you have landscaping, the condition of property. There are a lot of components that help you to understand the value of the home. Now, let's say that both of these houses get the same amount of credit for location desirability. Let's say they're both landscaped. They both have 3 bedrooms. They both have 2 bathrooms. They're gonna get very similar credit for each of these items. Yes, the larger home will get credit for the extra square footage, but the smaller home is going to have a higher price per square foot than the larger home, even if the larger home is more expensive, because you just have more square footage to spread that value over. And I express this because a lot of sellers and buyers want to simply use price per square foot to establish the value of the home that they're interested in or the home that they want to sell. But if you take that price per square foot of the little home and apply it, adjust it for the extra 1,500 square feet of the larger home, you're gonna get an astronomical number that's not going to appraise. The value is gonna be way off. And vice versa, if you take the price per square foot of the larger home and adjust it, you're gonna get a much lower number than the actual value of the smaller house. So price per square foot, it's an important tool, but it's absolutely not the only way to establish value. Another major misconception is that the Zestimate is the true value of a home. The Zestimate, in my opinion, is probably more accurate than other consumer sites in our specific area, but it's still gonna take an agent to have eyes on the property to understand the quality of finishes versus the comps. They're gonna be able to have conversations with the listing agents to get more insight into why homes sold for what they did. The algorithm can't see the updates in the interior. It doesn't understand dividing lines of value. So historically, some neighborhoods always sell for more than the neighborhood across the street.
Zillow claims that their median error rate is 2% in California, which sounds very low. However, only 79% of the time they come within 5% of the actual sales price. So that's a C+ rating for projecting the actual value. In a competitive market, especially as rates start to fall, a C+ average is likely not going to help you get your offer accepted. And as we've discussed, the sales price doesn't tell you the full story. Only an agent can get that inside information as to how much seller credit a buyer may have received, the condition of property, were there any closing costs wrapped into the purchase price, and did the home appraise?
So although it's a helpful tool because other consumers are also looking at the Zestimate, it's by no means an accurate way to establish value. If you're considering buying or selling a single family home with a separate attached or detached unit, they're called ADUs or accessory dwelling units, then you really need to understand how an appraiser may assign value to that property. You're not going to get the same price per square foot that was applied to the main house to the smaller house, and unfortunately you cannot utilize the income generated from those units or potential income generated from those units to help establish value. An appraiser has to look at recently sold homes with ADUs to help assign value to your ADU. In Solano County, we're starting to see more and more houses with these units, and new construction folks all across Solano County are starting to incorporate attached ADUs to their layouts. However, sales of these ADUs are few and far between. So when you don't have a lot of data to work with, it's not uncommon for these units to be somewhat undervalued. Now, there are remedies. I would chat with your lender, chat with your agent about potentially getting some sort of regression report, which would give you a longer time frame or span of time with more sales to help establish a truer value for that unit. These units, after all, are incredibly functional. You could be renting them out each month to help offset your mortgage. They'd be great for multi-generational families. They carry a lot of true value and function, so perhaps the method of valuation will change in the future, but for now we have to rely on the market and recently sold homes. So if you see a seller who's claiming in Solano County that their ADU is worth hundreds of thousands of dollars, that's going to be a red flag. It's certainly not going to appraise for that. Unfortunately, because our data is sparse, it's unlikely that you're going to get that kind of valuation in Solano County. My last pro tip is, did you know in certain circumstances you can potentially refute an appraisal or request a second appraisal? And I want to preface this by saying you can't do it just because you're not happy with the valuation that the appraiser applied. You have to have real concrete evidence as to why the appraiser should be requested to take a second look, or an entirely new appraisal should be ordered. Concrete evidence would be the use of inappropriate comps in your opinion. So for example, maybe a comp is listed as a major fixer and somehow the appraiser didn't see that note, so that brought down the value of your property. Or perhaps they missed a comp. Maybe it was an off-market sale. The appraiser would have had no way to find that data. Those are concrete reasons why you could request the appraiser to take a second look. And the appraiser would not have to oblige. They've done their job, they've been paid for their job. However, I've rarely run into issues in situations like this where an appraiser would not take a second look. They are true professionals, they are a neutral party. So if there is more accurate information, they're more likely going to agree to consider it. If there are falsities, false statements, bias, anything to that extent, then definitely having a conversation with your lender about whether it's appropriate to request a second appraisal. Again, it's a lengthy process. However, it's important that you know that you could potentially be eligible to do so. I hope this information was helpful. I'm always here to help however I can. Please reach out to me at monroe.erica@gmail.com.